Thank you very much. Good afternoon, everyone. So a bit to introduce this panel, I would say, as you all know, that growth tech listed stocks have plummeted last year, even if it's increasing a bit now. It's particularly a result of inflation, of course, and higher interest rates that impact growth stocks. On the private side, the number of big equity checks have also reduced. Layoff plan, in particular those recent days, have been being implemented in a lot of tech companies, in particular big tech companies. But in this somewhat gloomy picture, we try to be positive about this asset class, and we try to explain why it's still an attractive asset class, and more broadly, why tech asset classes in pre-roll are attractive for GP and LPs. And to start with, we can ask what do you expect from management today in terms of profitability versus growth, and how can this positively impact your return as a GP, and maybe Elina and Guillaume as a growth investor in equity, you can answer this first question.
Happy to start. So first, jumping on what you said earlier, we encourage our companies to control what they can control. So there are multiple shocks that are happening in the market, and we expect them not to try to control the FX rate, not to try to control multiple types of costs that may be exploding right now, whether that's cost of energy or whatever. We encourage them to not lose sight of what's really strategic. And typically in down markets, what's interesting is to acquire other companies. It's a good market for buyers. And you are probably tempted to buy some very discounted assets and so on. But it's a good idea to try to focus on the assets that are really strategic for you. So even though you could have like these bargain assets that you could buy for like a small part of your equity, makes sense to try to look for the bigger fish. And so how does that correlate with our returns? We also encourage them to understand like what's the new normal in terms of valuation. So probably the multiple, the valuation that they fetched like 12, 18 months ago is probably not the type of multiples that we'll have when we exit or in the future. So we want them to like understand this new reality, understand with us what's the numbers, what's the likely environment we may stabilize in, and so that we build a plan that makes sense and where we can deliver the returns and the types of exits that we intended to, while still capturing the opportunity that we saw in the market. So there's not an absolute like growth numbers that make sense these days. It used to be triple digit, like in a way in our market. I'm not saying that today the right pace at which you should grow is 30%. It all depends on the industries you're in. There are areas where growing at 30% is really stellar, and there are others where we're probably lagging behind others if we grow at 30%. So for us, what it means is like not lose sight of what's the strategic growth rate we need to have in several industries, but obviously managing what's the expected multiples we have in the future.
Thank you.
I very much agree with Elina's last comment about what we are pushing as an agenda with our portfolio companies. It's not anymore about how fast are you going to grow next year. It's about how efficient will you be next year. So we are focusing a lot on sales and marketing efficiency, overall efficiency, but definitely when it comes to unit economics, €1 invested in your sales and marketing team has to provide you with somewhere in between 0.5 and €1 in ARR. If you are below that, you need to fix it. If you are not doing it, you will not be able to gather more money. So it's very much about focusing on yourself, on your sales efficiency, on making your company kind of on track to profitability, focusing on your product. It's a good year to listen more to your customer, take care of them, and with that, we expect our companies to be able to go back to the market again in decent conditions and raise, maybe not as they were raising a couple of years ago, but it's not going to be a trouble for them to get more money to keep growing. That's first. And second, when it comes to return for us, in my opinion, this accelerated go to profitability is going to help us get more exit paths, meaning if you want to get very good valuation from private equity, you need to prove you can become profitable in a short time frame. All right? So if you never did it in your whole lifetime, meaning we are talking companies that are already there for close to 10 years, if you haven't been able to demonstrate you can become profitable, it's not going to be very appealing for private equity. Same for strategics. If you want a big check from a strategic, of course, you can go for Adobe, Amazon, and whatever, but that's not going to happen every day. So if you want an exit with a regular strategic, you need to prove you are or you are able to become profitable. Our companies are in that path, becoming profitable, and that's going to open us a lot of exit paths, private equity, strategic, and maybe IPO just as before. That's fine, but multiple options means a lot of competition. Competition is price.
Yeah, definitely. And in this context of more difficult access to equity and lower valuation, do you think there is other asset classes in tech, other type of financing that can be attractive? Maybe Olia in credit, you can describe a bit this?
Sure. I obviously represent a credit investor focused on growth stage. For us, the deal flow, of course, increased significantly over the past probably 6 to 12 months. That being said, I think it reflects partially the maturity of the European ecosystem. There are simply more companies in Europe that are larger. So we've looked at the market last year at sort of companies that are 100 million plus in valuations and up to $1 billion, and there are over 3,000 in Europe, and it's a market size of 2.8 trillion. I think the use of proceeds has changed. I think Elina has mentioned that M&A, so we see a lot of strong software businesses seeing an opportunity to expand in particular products, which was probably less of a case last year because they could effectively raise equity at very little cost. So now debt becomes a much more favorable, and it also makes sense, obviously, to diversify your capital structure.
Thank you. So we talked about the discipline at the GP level for your portfolio company, but what do you expect in terms of discipline at your level for the GPs when you're as an LP?
Yeah, sure. So as an LP, we talked to a lot of GPs. There's a few trends that we're seeing that are a little bit concerning that we're pushing back on. I mean, I think over the past 3 years, it was really easy to hold companies that had gone public and looked like a genius. I mean, everything just kind of went up. We had a few GPs who held public positions way longer than they should have, and obviously the market goes both ways. And so we're really looking at our GPs to look at when they're taking liquidity, and I think we're even having conversations now about selling secondary earlier because we had many GPs who have said they had opportunity to sell secondary, but these companies were great. They wanted to hold on to their winners. And I think they're looking back and they kind of feel a little foolish. They should have taken 10% off the table, covered their costs or a portion of that, returned some money to LPs versus having funds that were 5x come down to 2.5x and look a little silly. Similarly, I think we want our GPs to stay consistent in strategy. I've talked with a few large growth equity firms in the US who don't see opportunity right now given where multiples are. And instead of just kind of sitting back and watching and observing, they're saying, well, we want to keep our team active. And so instead of writing one $50 million check, we're going to write 10 $5 million checks. It's just less risky. Like it's a $5 million check. It can't go that bad. That's not your strategy. So to see a growth equity manager shift like that just to keep a team busy, it's another kind of sign that we're not happy with. So we want our managers to stay focused on their strategy and execute on that. And similarly, I mean, you invest in venture, you expect to lose money. We expect to lose a portion of our money. I think there's long-term loss rates over double digits. But we want to see our GPs really work out on companies where they can add value and not just let them flounder and die. We'd rather see them try and get recoveries where they can. And I think the GPs that really stop and focus on their problem children and fix those are the ones that are going to come out and come ahead, and those what we're really focusing on. That's what we're telling our GPs.
Thank you for this. And in this context of higher interest rates and lower valuation for listed stocks, or higher part of private equity assets in the whole portfolio of LPs, how do you think venture growth and more broadly tech asset classes could be attractive asset class in this context and over the long term? Maybe you could.
Yeah. So generally, I mean, venture is long-term asset class. So there's a lot of volatility right now, but we're kind of looking at the 10-year horizon, the 15-year horizon. We think it still definitely makes a lot of sense to be in. I think, let me know if I'm missing the point of your question. But I mean, you look at healthcare GPs that are like literally curing cancer, figuring out how to cut tumors out of people better. You look at ERP systems that tech entrepreneurs are founding that are making people more productive. And I mean, those things are all adding value to the economy. And I think long-term tech is a place to be. I mean, it's going to be for a long time. And VCs are optimistic. So I think even though right now it hurts, I think, you know, you go to a conference and everyone's talking about the new greatest company and not all their problem children that they probably should be talking about. And so I think even though they get hit on the head 5 or 10 times, they're going to be right back there putting more money out.
And I think if I may add, I think the perception of tech is actually changing, and it's no, in our opinion within GP Bullhound, it's not really a vertical, if you would, because you cannot imagine a software business or a healthcare business without software integrated. You cannot imagine a finance business without any software. So it's really becoming an incredible part of the whole economy. And so you just need to look, obviously, at sectors that make sense. Healthcare, again, it comes to mind. Yes, what we have seen over the past couple of years is sort of over-proliferation of copycats, and I think that's a healthy you know, environment that we've seen that disappear or these business models not being funded. But I think the future of tech is actually very bright in some ways because it is what's driving the economy forward, any sector of the economy.
And taking a step back on the asset class and comparing also against other probably. So what we're seeing also, looking just at the publicly listed companies' numbers, so they're still reporting very, you know, high growth in line with the analyst expectation for the most part. We're seeing increased penetration of the cloud, as you already said, obviously the penetration of software across multiple sectors. So these are very fundamental trends, that's one. Very resilient business models, fundamentally, notably indexed on software, so very healthy quality of revenue. We're seeing a number of companies that are a little bit less, more immune to the energy prices, to also the interest rate increases, because most companies are little leveraged or don't have leverage at all. So all of that makes the ecosystem fairly resilient on the back of these fundamental trends.
Yeah. Maybe I may add that the whole ecosystem at large, maturing is kind of providing investors with the whole range of risk-reward returns available out there. For a while, in Europe, technology was venture. So it was very hard for large institutionals to bet on this kind of place. Now, it's ranging from venture, seed, pre-seed, seed, Series A, to pre-IPO. So basically, you want to get exposure to technology, you can find out there the right GPs that are providing you with your flavor of risk-reward profile. And that wasn't the case, and now it's way more easy for kind of close to any professional LP to find the right returns they are looking for and the right risk profiles that is fitting the mandate. And you get everything in Europe now for on that respect.
Yeah, just in particular, you know, you mentioned different asset classes in tech with a different risk-reward profile. And are there more niche classes within the tech asset class that can stand out in the short term or over the long term in this context?
Yeah, we're seeing a bit, taking our sustainable investor hat, we're seeing a little bit more capital flows these days to you know, climate-driven businesses, anything that's around energy efficiency and so on. Obviously, there have been a number of tailwinds in 2022, but this is a trend that obviously has accelerated now. So definitely, this part of the market keeps on being very dynamic and increasingly so. That's also on the back of like the Climate Act in the US and so on. So multiple funds chasing assets in this category. We're seeing also a fairly good dynamism around cybersecurity. So everything that's about equipping this digital economy, the infrastructure and so on. So this is a way to get exposure to the asset class while not taking the application risk, but rather like powering the infrastructure, the tech infrastructure behind So these are the areas that we're seeing, being resilient these days, and a little bit less volatile than more traditional sectors.
You want to comment on your particular asset classes, Olia?
I think obviously within credit we have seen significant increase in returns, mainly because obviously there is still a need for capital. Interest rates have risen. Yes, you have correctly pointed out that many of the companies don't have high leverage or very low leverage. So for them, the cost of capital changed, and for them debt became much more attractive because equity became much more expensive. So from that point of view, I think we see very positive trends.
Nate, you also look at different asset classes in tech in Europe, or which one you think could be attractive in the near future?
Specific to asset classes in Europe?
Yeah, within tech.
Okay. Yeah, I mean, generally, we have a pretty broad portfolio, so we're not necessarily sector-specific specialists, but we do have a few growth equity investors in Europe that have seen really interesting things happen with rising rates, from companies that were cash flow negative to becoming cash flow positive just on net interest income because they hold a lot of deposits. So I think there's definitely green shoots that are coming out of this, and there's things that were unexpected. Even the companies didn't really think about this until they redid their models and they were cash flow positive next year. So there's no huge area specifically. I think EU is definitely ahead of US on ESG, climate, and the like, and so I think we're probably going to follow leadership there. But generally, we're more generalist investors. We trust our GPs to make those hard decisions for us.
And how do you see Europe compared to the US in terms of attractiveness for this asset class? Is there a difference?
Yeah, I think that's a super loaded question to ask me in front of all these people. No, I'm just joking. Obviously, I'm a little bit of a younger investor in venture. I think there's definitely differences between the two ecosystems. Similar GDPs, I was recently told. But Europe has 1.5 developers for every one developer in the US. Europe has 65 cities with unicorns. I think US probably has a smaller number, but the interesting thing about the US is they all speak the same language. In Europe, they all speak different languages. There's different cultures and things like that. And so I think our view is that you need to have specialists on the ground that really know their geographies, know what's happening in each kind of venture hub in the geo, and allocate there. And we do a similar strategy in the US. So I think there's a lot of similarities that way, but there's also, a fair amount of differences. Generally, we're taking a 10 to 15 year view, as I mentioned, and so our thought is that, Europe has historically lagged the US as far as dollars deployed in tech and the like, but those gaps are definitely decreasing, and there might be parity here soon. And so we're kind of looking at that 10-year horizon, that 15-year horizon, and starting to make bets now that we think will pay off then.
So we talked about the discipline at the GP and the LP level. Do you think it will last for over the long term, or just a fade based on this context? Guillaume?
Thank you for this very compelling question.
Maybe you can forecast the future crisis.
Look, I might slightly disagree with the question itself. I think what we are seeing at the moment in the market is not a problem of discipline. It's a problem of an appropriate vision of the market a few years ago. If you think capital is going to remain cheap forever and valuation will be driven by growth forever, it's just logical to go for these entrepreneurs that are providing an investor with a play around high growth, not even having a look to profitability. But of course, this paradigm, growth at all cost and cash available, how much cash do you want to get, is not true. So the question is, are you able to feel in what cycle you are or not? Again, 5-6 years ago, it was logical. Again, I'm not saying you were obliged to go after this strategy, but it was kind of logical to fund these companies. 2 years ago, it was already becoming more challenging because the valuation were extremely high, and we all knew we were kind of dancing around a volcano. So when should we change the strategy? And that happened now.
What do you think, Elina, on this? Or Olia, you wanted to?
I think in that sense we are very great helping hand for our equity co-partners, in that we've, as debt investors, we've always been very much focused on profitability and discipline, obviously through the nature of covenants within the loan agreements. And I think it actually helped companies, many companies, to grow up and to a little bit understand, yes, growth is important, but we need to keep to certain reporting requirements, which are very different for debt than they are for equity. And I think that's also a positive development in today's market, because the companies are now naturally coming to that and saying, yes, we need to, yes, growth is important, yes, certain markets for us important, but let's think about the cost of that growth and how we do that, and the efficient use of capital, wherever that capital comes from, whether it's debt or equity.
And maybe adding on that, part of the market highs of last year have been, and the year before, have been fueled by different types of investors coming to the European stage. And this is also something that we've analyzed in our crossover report. And these investors obviously have pushed the market in certain directions, but fundamentally what that market has proven is that Europe is part of the global stage for venture and growth investing and debt investing as well in tech. And so this is fundamentally what has happened. So the diversity of investors that we have today, coming from the US and from multiple fronts, and also increasingly so US LPs funding GPs like us, is just proving the attractiveness of the European tech market. So obviously the market will go through ups and downs in terms of the valuations, in terms of the growth we expect, in terms of the profitability we expect. We're all adjusting to the financing parameters all the time. We're doing that on a constant basis. But fundamentally, the long-term trend is that there are multiple types of capital coming from multiple continents and different types of risk reward, as you pointed to, that are going to the European market. So that is another, that's an important signal of the maturity and the increased sophistication of our asset class. And there are just many signs to that. And so I hope LPs and investors will not only remember the excesses of the past couple of years, but also see the bigger picture there.
Sometimes the crisis can come from the US, so maybe the discipline should apply also to USGP. How do you make sure? You talk about how busy can be try to be busy. Some teams are. So how do you make sure they are busy on the right thing or not busy when they shouldn't be busy?
I think I'd like to say that we personally were not part of the problem that I think is being subtly pointed to here. We kind of stayed out of the growth at all cost phase with our GPs. I'm sure there's some edge cases in there, but generally we didn't fund a bunch of big hedge funds that came over and shot money out of a cannon at a bunch of startups and funded the third Uber. So I think it is really incumbent on LPs to keep their GPs' feet to the fire. I mean, I was in Silicon Valley 2 years ago and was talking with a really well-known GP, and we said, when is this excess going to end? They were talking about how engineers from Salesforce could threaten to leave Salesforce and get a $2 million cash offer to stay. And I'm not sure how valid that story is, but there's just a lot of money in tech. And he said, well, when you guys stop giving us money, you're the problem. And we kind of sat back and like, what? The LPs are the problem? And then when you actually think about it, it is LPs that are funding GPs that are making decisions that maybe I personally wouldn't agree with, but different LPs have different risk-reward profiles and different risk appetites. And so I think it really is incumbent on LPs to kind of be the torchbearers there and ask the hard questions. I think when there's a lot of money flowing into the ecosystem and into venture broadly, it's really easy for GPs to say, hey, look, we're going to close in 2 weeks, and your docs are they're not, and maybe we'll talk to you. I think that's definitely shifted the other way, and I think LPs really have to make sure that we keep that dynamic in line. Like, it shouldn't also go to LPs and we push on our GPs to get 50 bips management fees and 5% carry. I think then you probably change incentives as well, but we need to make sure that pendulum doesn't go one side too far to the other. So it's on us, unfortunately. I'm sorry, guys out there.
Guillaume, you talked about the exit, and exit are part of obviously the return you can make as a GP. Europe has been always a bit lagging behind in terms of exit. How do you expect entrepreneurs to make exit in the next couple of years in the context, and to be sure that there is liquidity for your LPs?
Yeah, I think it's about the whole ecosystem maturing. For many, many years, it's been all about funding the growth and the maturing itself of the ecosystem. Now, we are seeing some companies that have reached not a seller, but they are more thinking into what would be the next step. It's not going to be probably growing or doubling the size of the company anymore. It's going to be more about generating some return for their existing investors, because that's part of the game, of course. So they will start thinking about, are we going to launch an M&A process on 100% of the company, or do I want to keep pushing this company, maybe not at 100% growth, but with 10-15% growth, and I want to remain leading this company, so I will organize something that is more looking like an LBO or an OBO. And that's very much in the head of many, many late-stage investors that are late-stage entrepreneurs that are not anymore about only cash in, but also reorganizing the whole cap table. And this is happening at the moment. We are seeing exits, 100% exits, strategic private equity, but also minority or cap table recomposition with private equity players that are providing capital to buy back some shares to initial sponsors, provide some liquidity to the entrepreneurs themselves, pour some money into the company because the entrepreneur has plans to keep pursuing this growth, not as fast as priorly, but decent growth. So we are seeing the whole spectrum of strategies, 100% exit, but also structured transaction around what happened in small cap 15 years ago, about small LBOs, OBOs, and other kind of structured operations.
I'd just like to add to Guillaume's point, like I mentioned, LPs are responsible for some of the excesses of our GPs, but at the same point, GPs have to be responsible for their companies. And I think we've heard these GPs talk about how they're now holding their entrepreneurs' feet to the fire to make sure that they're growing reasonably. And so, I mean, our pendulum is one way, and I think theirs is also shifting the same way. And so it's on us to monitor our GPs and on our GPs to monitor their founders.
Maybe, Elina, you want a word of conclusion on this?
No, I was thinking about also the exit environment, which has changed a lot when you look at potential future listings. So no one knows what will be the new normal. So it used to be that you had certain metrics that you should reach, and let's say as a software company, if you want to hit the NASDAQ. So it used to be like 200 million of revenue in terms of median size you should reach, a certain gross profit, certain cash flow generation or consumption. And so now all of that is going to get reset. So we don't know when the market are going to reopen. But there's definitely a big backlog of companies that is piling up now. And we understand public market investors are, watching that and expecting these, new flow of assets coming to the market. And at the same time, the entrepreneurs that are on the waiting line, they are also really, as we said before, like increasing the profitability faster than they would have in the past, getting to a bigger size potentially. So potentially this 200 million mark will go a little bit higher. So yeah, on average, try to find ways to de-risk the asset before you go to the public market, so you reduce the unpredictable character of your growth and your journey. So this is what we're seeing happening for the later stage companies that still have the IPO plan in mind, whenever that is. And we think it's important to, keep nurturing that healthy pipeline of future large listings.
Thank you very much. I think it's time, and thank you for attending this panel, and thank you for the panelists.